Investors, let's call last week what it really was. What was that? It was fast money. I remind viewers and listeners that these videos are scripted on Sunday, filmed by Eric and his crew on Monday morning, edited and reviewed by our compliance team during the week, and released on Friday afternoon. A lot can happen in 5 days, both good and bad. Suppose you were paying too much attention to the markets, watching the moves hour by hour and day by day. In that case, you are likely running with high blood pressure, or at least very anxious for the last 2 weeks of July. However, if you were out on vacation without any news or quote service, or just watching the Olympics, if you weren't fast money, you're probably wondering what the big fuss is on the markets, as they are spot on near flat since July 4th holiday, and actually marginally up for the month of August as of this writing. Investors, we are near right back to where we started from. Investors, as a quick recap, stock markets made an all-time high of about 56.69 in the middle of July. They then sold off violently into the second half of July. The S&P 500 cash index opened Monday, August 5th, down another minus 3% to take the index down minus 9.7%, peak to trough, over about 3 weeks or 14 trading days. The exclamation point of the thumping came on August 5th, Monday, when the Japanese markets took a tumble of minus 11% on a waterfall decline, dragging down the global stock markets. The cause for Monday's decline? An unprecedented blowing up of the unwind in yen carry trade. For 2 weeks, we've discussed these moves down in price and up in volatility are quite normal for summertime, particularly late in an economic cycle. Last week's video titled Markets in Turmoil, Yen There, Done That Before, August 2007, took on how historically similar the current move down in stocks and up in volatility was to the summer of 2007, almost to the same week in August of that year when the last yen carry trade implosion happened. The main message was from the video, was it time to panic? Our answer then was, history said no. An investor shouldn't panic even though fast money and volatility was spiking. Our message with the markets down was that there should be a better selling opportunity in the coming months from a higher level, later in August, maybe all the way into September. For those of you who didn't see our last 2 episodes or without access to historic charts and data, take a look at the chart of the S&P 500 back in 2007. Investors, as one can see, the early third quarter summer peak was near the same time as this year. And the percent decline of the cash S&P 500, peak to trough, closing low, nearly identical on a percentage basis at about 9.5% down. Even back then in mid-2007, which of course we know with hindsight was the beginning of what would become the great financial crisis and recession in 2008 and 2009, the stock markets rallied strongly over the rest of the third quarter. Many investors forget that stock indexes went on to make a marginal new all-time high in early October of 2007. The other time we've referenced all of 2024 for being eerily similar to now is 2000, during the early internet CapEx build-out. Once again, take a look at the chart of the S&P 500 for 2000. Near the same time for the midsummer sell-off back then, near the same percentage down as 2024, near the same time for the August rally to begin, and even back then in 2000, the S&P 500 went on to clear its mid-July high before topping out for good for years. Investors, why do these 3 periods all look very similar when it comes to stock markets, returns, rotations, and sector and stock leadership? Because all 3 periods come after the Fed has been raising rates, trying to slow the economy, trying to lower inflation, and hit a soft landing 10.0 Olympic score, which has historically been rarer than throwing a perfect game in the Major League Baseball. Fed is trying to recreate the 1995 economic outcome of a mid-cycle slowdown followed by a longer-term low growth, low inflation, economic expansion. Not too hot, not too cold, just right. The markets are on edge because they're struggling with, are we mid-cycle, which would say stocks have years of more consistent gains ahead? Are we late cycle, where stocks would be okay for a while, returning investors for maybe another 9 to 18 months? Or are we end of cycle, where stock markets are topping and rotating into safety sectors because they are forecasting a downturn in the economy and earnings in 2025? Well, we still can't definitively answer that question, but we do believe that over the next few years, active stock management will begin to reassert itself and begin to be rewarded relative to passive investing. Since the markets have rallied strongly the last 2 weeks back to near 55.55 and volatility has subsided lower, Now is a great time to meet with your financial advisor or your financial planner if you have one, if you have a relationship beyond an investment account. While the Oak Harvest investment team's second half outlook hasn't changed, it's best to make financial decisions when markets are calmer and your anxieties are likely to be as well. In both the prior cases of 2000 and 2007, the markets rallied strongly in August as they've already done. In 2000, the markets made marginal new highs versus its mid-July high into Labor Day weekend. In 2007, the S&P 500 rallied over 10% off its August lows to make a marginal new high into early October. Such outcomes, if repeated, and that's an if, would take the markets back to 5,700 to 5,750, and yes, maybe even 5,800 over the next 2 to 10 weeks. Inconceivable to some only 2 weeks ago when we first referenced this data. Will that happen? I don't know. Can it happen? Sure, why not? We have a good labor market with decent employment numbers, which means strong 401k payday flows every 2 weeks. The Fed is starting to talk dovish into Jackson Hole, which is ongoing this weekend, and they are likely to talk dovish throughout much of September into the Fed meeting. I would think the Fed will look to continue to calm volatility in both stock and bond markets, and any exhaling of anxiety will likely lead to performance anxiety and stock chasing, stocks chasing them back to the upside now that many leveraged players were forced to sell and who are now lagging in their third quarter performance. Investors, the Fed is too tight in my opinion. The bond market knew it weeks ago, and the stock markets are struggling with it. We've seen this playbook before, but before you panic, remember these prior periods before the Fed found QE, quantitative easing, and many other programs they used to dull and delay economic and market downturns. During both of these prior periods, the markets did not cascade lower from where they were in a straight line while they were previously discussed the years 2000 and 2007. Investors, I repeat, during both these prior periods, the markets did not cascade lower from where they were in a straight line, those years 2000 and 2007. Those were cutting cycles that happened after that. They did end in recession though. They were pre-QE, characterized by a lack of liquidity. Quantitative easing in a significant size has been implemented since then, and you know what that has historically done to tame volatility in the markets. So as we've messaged for the better part of the third quarter, if over the years you found yourself reacting emotionally in your portfolio to presidential elections and their uncertainty, or when volatility is high like it was a few weeks ago, now is the time to step back, take a deep breath, and give your advisor a call so they can walk you through your financial plan. Take out your phone, give them a call, and see what might work for you for your longer-term financial plan. Do it while the fast money has been sidelined for a while and volatility is calmer. Do it when the markets have bounced and we're right back where we started from. If you are uncomfortable with a wider range of possible equity outcomes, the Oak Harvest team has launched a new strategy that retains the ability to go long stocks, short stocks, as well as buy partial hedges and shock absorbers for your stock portfolio. Information on this new strategy can be found at oakharvestfunds.com. For myself and the whole team here at Oak Harvest, have a blessed weekend and a happy Labor Day.